In the aftermath of World War II, the Bretton Woods institutions were created to stabilize the global economy and rebuild war-torn Europe. At that time, their design reflected the power and interest of the victorious nations, who were also their primary shareholders and beneficiaries. The IMF was tasked with upholding the gold standard exchange rate system, while the World Bank was established to finance Europe's reconstruction. Both have since evolved into development finance institutions, but their structures, decision-making, and governance remains dominated by wealthy nations. Today, the global context is vastly different. The global standard collapsed 5 decades ago, and Europe has long since been rebuilt. Yet, the governance of these institutions has not kept pace with needs of a multipolar world, especially the needs of poor and developing nations. The mismatch between shareholders and stakeholders has become starkly visible. For instance, during the IMF's recent allocation of special drawing rights, 64% went to wealthy nations. Just imagine, 64%. With little need for liquidity support. They didn't need the money anyway, but they got 64%. While the poorer countries received just 2.4%. What a disconnect. The imbalance highlights how the very institutions meant to safeguard global finance stability often perpetuate inequality and instability. I have argued, and I say it again, that the current global financial architecture punishes poor countries with high interest rates and enormous conditionalities, while rewarding rich nations with lower interest rates and softer lending rates. Its rules, priorities, and allocation mechanisms consistently favor those already prosperous, while trapping vulnerable economies in cycles of debt, high borrowing costs, and inadequate access to emergency support and concessional funding. It is imperative to transform these institutions into genuinely independent, apolitical global bodies that their operations are aligned with their global mandate. Such a shift would democratize decision-making, restore credibility, and allow the IMF and the World Bank to serve all countries fairly rather than reinforcing old hierarchies. But Africa is not merely waiting for external prescriptions. We are taking bold and deliberate steps to strengthen our financial independence, safeguard our stability, and accelerate our development. Kenya, for instance, fully endorses the establishment of the Alliance of African Multilateral Financial Institutions, launched with the Africa Union in February 2024. This alliance brings together our homegrown banks, Afrexim Bank, the Africa Finance Corporation, the Trade and Development Bank, Shelter Africa Re, Africa Development Bank, Africa Trade and Investment Development Insurance, and ZEPRI, institutions that embody Africa's determination to mobilize resources, finance trade, and build resilience on our own terms. At the same time, the Africa Union is championing 3 transformative institutions: the Africa Central Bank, which will issue a single currency and free our trade from dependence on foreign money; the Africa Monetary Fund, positioned to stabilize our economies and give us true financial sovereignty; and the Africa Investment Bank, designed to mobilize resources for infrastructure, industrialization, and integration that Africa needs to rise. And to complete this vision, the Africa Credit Rating Agency, one that understands our realities, values our uniqueness, and tells our story with fairness and truth, has already been established.